Very, very happy to have everyone join us this morning. My name is Mark Johnston, your host for VID5, the latest in our conference series, and brought to you, of course, by Laurentian Bank Securities. We are on day 2 of our VID5 3-day conference. I also want to thank our partners on board for this conference, BTV, Newsfile, Crux Investor, First Phase, and Mining Network. This event is for you, the investor, to get to know the people behind the companies in the mining industry. Today, we welcome the following featured companies: Major Drilling, Gold Mining Incorporated, Monarch Mining, Guanajuato Silver Company, Major Precious Metals, Nighthawk Gold Corporation, Ridgeline Minerals, Magneterra Minerals, Lucky Minerals, plus a panel moderated by our sponsor, Laurentian Bank Securities, on exploration, development, and investing in Quebec. Please let us know where you're tuning in from around the world, and keep in mind your questions today can go in the Q&A column for each of our guest speakers. With that, let's begin with our first session this morning with our keynote speaker featuring Denis Larocque, President and CEO of Major Drilling. Good morning, Denis.
Good morning.
I will leave this in your good hands, sir. We know we have a great session with you coming up, so I'm all ears. I'm going to step to the side, and we'll come back around, folks, with questions for Monsieur Larocque at the end of our session. Denis, over to you.
Perfect. Well, thank you for the opportunity to present this morning, present our perspective, the perspective from service providers, and more particularly drilling companies. Before I start, I'm going to make a lot of forward-looking statements in this presentation. I'm going to give you my view on the sector and on where I think things are going. And so therefore, here's a disclaimer about everything I'm going to say after this slide. Just a little bit of context in terms of who we are. We are the largest, one of the largest provider of mineral drilling services around the world. We're registered in 20 countries, over 3,700 employees, over 600 drills operating around the world. About 80% of our revenue comes from seniors and intermediates, including companies like Rio Tinto, Newmont, Barrick, Vale, Freeport-McMoRan, and other companies like that. We also have 20% of our revenue that comes from juniors and growing, as you can appreciate with the amount of financing that has been done. Myself, I've been with the company and in the industry for 28 years, so I've seen ups and downs, and I've seen a few cycles in my career, and that's the perspective that I wanted to bring this morning to this discussion. So in terms of, as I mentioned, our revenue breakdown, and this is from an industry perspective, on the commodity side, very similar. On the customer side, we have a higher proportion of seniors just because we bring higher standards to the table, and therefore we face less competition when we're dealing with seniors than we do with juniors. But still, as I mentioned, just the last quarter, our junior has grown from 20 to 24%. On the commodity side, in terms of our revenue breakdown, what you see here is what we had over the last quarter, which we just released last week, and this is unusually high on the gold side. In fact, even the quarter before, we were at 60%. And historically, gold has always been around 40 to 50% of our revenue and also of the industry activity. And then copper always makes up between 20 to 25. So between copper and gold, you typically see about 70% of the activity in exploration. And then the other 30% is what I call flavor of the day, and nickel is always part of that, and these days iron ore is part of it. But if you roll back the clock 12, 15 years ago, uranium was a big number in that part. making up at that time was making 10 to 12% of our revenue. These days, you've got things like lithium, cobalt that are coming to the table as with drilling projects. But all in all, gold and copper are by far the biggest drivers of our activity levels, and that's quite important in terms of in terms of what we look for in terms of what goes on in the market. So when we look at gold and copper, our industry is driven by the supply side. We get a lot of questions from investors about demand and what about demand on copper and demand on gold, and those all add to the equation for sure. But really, if there was tons of supplies, we would be irrelevant. The demand would be irrelevant. The fact is that supplies are going down and going down fast, and the thing is that on the demand side, you all know that we're seeing ahead of us big demand coming from base metal. So when you look at gold, for example, the reserves are down with large companies. Reserves are down on average 35% from where they were in 2012. And they're down to levels not seen since 2005. And so therefore, there is the only way to replace reserves in the industry is through exploration and finding new deposits. So there is a big need from a supply perspective from the gold side. Then when you look at copper, copper is facing a supply deficit. We've been saying this for a few years. The chart you see there, we've been using that chart for at least 2 or 3 years, and it was pointing towards a supply deficit hitting in 2021, 2022. So we're moving into that. And already we're hearing things like Codelco, for example, that had their grades down 10% and their production numbers being down. And Codelco being the biggest producer in the world. So therefore, that has a big impact. And you do have some mines that are coming on stream, but the fact is that production has continued. And the one thing I should have mentioned, and I'll take you through this, is that we just faced, both for gold and copper, a 6-year of downturn with very, very little exploration carried out, which is what brought us today to reserve issues and supply issues, and that can't be fixed overnight. It takes 10 to 15 years to bring a mine into production. So therefore, if you start today trying to fix that copper graph there, you're only going to put the exploration, greenfield exploration that you do today is only going to fix things in 2032. So a long lead time and a lot of drilling required before you bring a mine into production. So therefore, when you look at copper, again, I've talked about the supply issue, but then you lay on top of that the demand that's coming, and it makes me a big copper bull, because we're seeing electric vehicles, and I'm sure you've heard all the stories. I'm sure every copper company is talking about the need for copper in the future, and it is there. 3.5 times more copper in a regular vehicle than in an electric vehicle versus a regular vehicle. And then you add on top of that charging stations and all the grid that needs to get built. That's a lot of copper that's going to be required on top of what is already needed just for regular consumption, which was already basically stressing the supply side. And so you lay on top that that potential demand, and it makes me a huge copper bull, and I see copper demand being here from an exploration perspective for years to come. And really, all of this is not new. It's déjà vu. It's basically the make of mining cycles. And here's the proof. Uh, as I mentioned, I've been here for 28 years, started in 1994. And in 94, when I joined the company was on a very rapid growth path, and right up to 1998. And then 1998, everything came off, and exploration budgets were cut. Gold price dropped to 250. For some of you that haven't been in the industry that long, yes, gold was at $250. Copper went down to 60 cents. And that basically gave us 6 years from 98 to 2004, or a very little exploration being done. And basically what happened is that when we got to 2004, you had all the seniors out there saying that they needed to rebuild their reserves. They needed to spend a lot of time um, in the to replenish their reserves. And what we saw is basically the make of a mining boom, which was went from 2004 to 2012, as you see here, cyclical upturn, interrupted by the financial crisis. But as you can see, the bars that you see on this graph is the amount of spending that was done on exploration. And you start in 2004, and it's a line straight up, again, interrupted by the financial crisis. But right out of the financial crisis, it picked up where it left off and kept going right up to 2012. And so we had that cyclical upturn, followed by, again, 6 years of cyclical downturn. And so if we chart this to history and look at what's going on today, it's striking the similarities. And in fact, I would invite you to go read our annual report, our message to shareholders back to 2004 and 2005, and you'll see that you could take what we wrote back then and transpose it today, and we could do a copy and paste, and you wouldn't know the difference. And the reason for it is, again, 98 to 2004, 6 years of lack of exploration. 2004, we saw the senior gold companies they were the first out of the block, coming out with bigger exploration budgets. Then in 2005, that we saw the window open for junior gold financing. So we saw a lot of junior gold financings, which then increased drilling campaigns from junior golds, on top of the senior gold that had increased their activity. And then we got to 2006, and all the gold players again increased their activity as they're basically building up towards building mines and definition drilling increasing. But then you've had copper in 2006 that climbed to the range of $4, and we were off to the races. That's where things became crazy in our industry. And if I go back again on that graph, you see that red line, and you see that it picks up in steepness. That's basically growth accelerated when copper came to the table, and basically when all three groups were competing for rigs, it created an environment where we ran out of rigs as an industry pretty quick, and we had to chase and add capacity. So, and then from 2007 to 2012, all those projects went into extensive definition drilling campaigns to build reserves. And I'll give you a classic example that some of you might recognize. You look at Ivanhoe at Oyu Tolgoi in Mongolia. We did all the drilling for them. We moved in there in early 2000 with a couple of rigs from Mr. Robert Friedland, and we ran the 2 rigs, and then they had a massive discovery, and all of a sudden, in no time, they wrapped up to 20 rigs for 5 years of intense drilling, and that's how typically things would happen. It's not every drill hole that will turn into a discovery, but the ones that do, then everything escalates to multiples of additional drilling for multiple years, as you need to define when you have that find, then you need to define what the deposit looks like, and you need to drill it in all kinds of different direction at different depths, and then you put that on a 3D model, computer model, so that you can see what it looks like. And that for that you need a lot of drilling. And another example of that is a Cisco that has just gone through 5 good years of drilling. They had 30 drills turning at the peak of their activity, and it's the same idea. They were basically defining and looking at what the deposit looks like, extending it, and they're still extending it, and even going deeper, which we ended up drilling the deepest hole for them on that property, as they were trying to see what was below the big finds that they had. So all of that was the previous cycle. Now you move into today, and again, 2013 to 2019, exploration budgets were cut. Very little exploration conducted by either gold or base metal companies, and it brought us to 2020, and all of a sudden the reserve issue came back to light, and it became a topic at these conferences, whereas from 2016 to 2019, the topic was everybody was talking about return of capital, and that's what mining companies were all about. They were talking about production and the cash they were going to generate. Now they've produced, and when some of them, when they look 10 years down the road, they don't have much on the shelf to sell. And again, it takes 10 to 15 years to bring a mine into production. So therefore, we got to 2020, and Senior Gold were the first off. They would have been out. We had early discussions in the beginning of 2020 with those gold companies, and they would have been out real early, but COVID hit, and all it did was delay it for about 8 months. When we hit August, they all were antsy to get going, and we basically had a very good season starting in August 2020, but all driven by Senior Gold. And at the same time, the window, because of the gold price that picked up, the window opened for juniors, and there was a lot of junior gold financing done. And when we turned to 2021, we saw juniors add a layer on top of what Senior Gold added to their budgets for 2021. So this calendar year, we saw our junior activity double. We went from 10% of our revenue to 20% of our total revenue on juniors, but on top of it, seniors added to the activity, and giving us growth. Basically, we've been able. Last quarter, we grew our revenue by 50% compared to last year. So lots of additional activity, and we haven't seen base metal yet. So a repeat again of the previous cycle. So when you look at 2022, it looks like we could see base metal come with higher budgets from all the things you're hearing and what you're seeing. For example, last year when copper companies were establishing their budgets for 2021, copper was just starting to move. They had been at the $3 level for a while, and they were starting to make their move towards that $4. So it was sudden. it was probably too early for copper companies to basically bank on that. And at the same time, you had the COVID uncertainty, basically same time last year, which caused companies to be more prudent and conservative on their budget. So we didn't see a big uptick this in 2021 from base metal companies, but now you see copper price have stayed above $4, and I mean well above $4 for all of 2021. And you're going into the budget season right now for copper and base metal companies. And you got to believe that it's a lot more interesting to be looking at increasing exploration budgets going forward. Will it happen early in 2022? We'll see. That's what we're waiting to hear. But then again, you lay on top of that the electrification story, which adds fuel to the fire. So I basically, my feeling is that we're going to see an increase in activity from base metal companies pretty soon. That will be an extra layer on top of what gold is already doing. And then you look forward, and again, for me, it was from 2004 to 2012, we had a 9-year uptick. Well, then what that tells me is that 2021 is only the second inning of a 9-inning game, and we're still very early, and a lot more to come, because those deposits that will be found or that are basically being worked on will require a lot of definition drilling going forward. So I feel pretty good about our industry going forward. So in terms of where we're at, and what in terms of major drillings positioning, the last upcycle, or coming out of the last down cycle, I should say, in 2004, we came out of there with a lot of debt on our balance sheet. We were not able to invest in our fleet, and we had minimal inventory on hand. And also in terms of people, we did what we basically had to let go of a lot of people down just to survive. And then we had to play catch up all the way through the last upturn in terms of adding equipment, adding inventory, and adding people, building up our teams. This time around, we entered the downturn with experience, having learned that those downturns can be really hard. So we entered the downturn with net cash on hand, a very strong financial position. Of all of our competitors, we were one of the only ones that had net cash on hand. Many of our competitors entered it with very levered balance sheets. So what it did for us is it allowed us to invest in our fleet, invest in our people, build, keep our teams in place. And so therefore we were ready for this uptick, and basically the proof is there. We just showed last quarter, we just showed the strongest growth of all the TSX listed drillers, and at the highest EBITDA percentage, and still building, because we're still very early in the cycle. And what we bring to the table also is a very strong operational leverage, because we've got an administrative infrastructure in place to which we don't have to add a whole lot. So don't have to add a lot of G&A to be able to grow our top line and our margins. So, and pricing is only going to get better as competition for rigs increases from mining companies. As I said, when everybody's looking for rigs, we're already at full utilization pretty much in Canada, US. So right now, if we had base metal come in with an extra layer, again, I think we'd be in crazy mode. So what to expect going forward in the next upcycle? One of the things is that the easy deposits have been found. the stuff that is shallow, close to town. A lot of those deposits have been found, and so therefore the next deposit will come from areas more difficult to access. It therefore requiring a lot more specialized drilling, which is what we have based our strategy on. We're known in the industry as the go-to for specialized drilling. And there will be a lot more drilling required for reserves to be proven. So therefore, about my view on extended time in terms of this cycle, I think we're still very early. Labor shortage is going to be a key challenge to manage, and we're already facing it in Canada, US, and Australia. It's quite a big issue, but we've managed it very well. And also, mining companies will need to consider ESG as part of their exploration effort going forward. It is becoming a topic that is gaining ground, and mining companies are paying a lot of attention to it the more it goes, and therefore they're going to have to consider that when they put a drilling campaign together. So if we with these points in terms of the next upcycle, if I look at it in a bit more detail, I talked about the next deposits coming from areas more difficult to access, requiring more specialized drilling. Well, that's, as I mentioned, that's where we have focused the company. We are focused on specialized drilling because they have significant barriers to entry. When you're focusing on stuff that is more difficult to access, whether it's deep in the ground, whether it's in Arctic, where it requires a lot of logistics, high altitude, remote locations, all of those things make it difficult for smaller players to compete in, and they typically will stay in what I call the conventional drilling part, because there's a lot of risk involved with the specialized. But when that's your specialty, you know how to operate those. We've got people that basically know how to operate in those environments. I mentioned the Osisko deep hole. You see there's a little picture there of our teams that drilled that 3,467 meter hole at Osisko, which was the deepest hole ever drilled in Canada from a mineral perspective. Quite proud of that achievement. But also, one other thing is top safety requirements. We do have some of the highest standards, and so therefore, when you're competing for a job with Rio Tinto, there's not a lot of companies that can basically meet their standards. They have some of the highest standards in the industry, and most seniors do. So therefore, limits the level of competition. So we tend to stay again in that sector, in the specialized part. I mentioned labor, and again, it's going to be a huge challenge. We are in Canada, US, Australia, we're already at full utilization of drillers, but we have a good system in place where we've got a good farm team of drillers that are coming through that have been helpers for a few years, that were able, and that what allowed us to grow, as I mentioned, last quarter by 50%, just by having the crews ready to go. And also, it's not just having crews. If you don't have the right crews, you won't be able to do any margins, because then the productivity is not there. You have a lot of breakdowns, you have a lot of issues, missed shifts, and that's where your margins get really affected. So we've been able to grow, but also hold our margins, and which is key to our customers in terms of meeting their demand, and all those in terms of quality, safety, productivity. And we've been able to hold that, and we are doing that by having increased our training efforts at our training centers, having some very good retention programs in place, and and also that helps attract people to our company. And we're leaders in terms of compensation, but leaders in compensation means that we're not the cheapest necessarily out there, but we do deliver. And when you need, and one of the reasons why some of our customers work with us is because sometimes they go in the campaign knowing that they're starting with 2 rigs, but they'll want to ramp up to 5, and they know that we do have the capacity to do that, and that we'll be able to ramp up if they need to, and ramp up with, again, safety, quality, and productivity. Finally, as I mentioned, ESG is a factor that mining companies will need to consider. We do, from an ESG perspective, from an environmental perspective, we do have a small footprint. Our rigs are small, and the biggest environmental thing that could happen is a spill from either a motor leaking oil or fuel from our motors. So we do have good process in place when we set up a pad. We have very high standards from that perspective. We're also continually looking to reduce our emissions and improving the motors on our rigs, and also reducing our water consumption. We do need a lot of water when you're conducting a drilling campaign, but we've been able to introduce water recirculation systems that reutilize water, and we've been able to reduce on those projects our water consumption by 90%. And those are on projects that require a lot of water, where we bring those systems, and having quite a bit of success. So on the social side, we've always been leaders. So all of this is not new to us. These are all things that we were already doing. So it's not because all of a sudden the ESG became a topic that we're all over this. We were already doing. So all we've done is we formalize what we were doing. So on the social part, health and safety, as we've always been leaders with very high standards. So we are continuing on that front. But the other thing is, operating in 20 countries around the world, you need to be part of the community. And also 20 years ago, we were an expat company operating internationally. So we had a lot of our drillers were Canadians and Australians. These days, we can't get Canadians and Australians that want to go abroad. So we need to be part of the local community, because our labor force needs to be local. And therefore, we're doing a lot of things locally, including in Canada, a lot of Indigenous partnerships across Canada, which again, when you talk about labor force in terms of recruitment, that helps with that on that front as well. So we're doing a lot of things. And then from a governance perspective, we do have, in terms of anti-corruption and code of ethics, we do have very high standards on that front. And if we can't, sometimes if we can't maintain that at a certain project or a certain area, we'd rather not operate there than operate at low levels of governance. And from a board perspective, 50% of our board are female members, and we do have very strong corporate governance structures in place as well. So all in all, as I mentioned, a very good story, very good time in our industry, and very, very well positioned, whether it's relative to our competitors or even just in an absolute term, very well positioned to take on what I think is a very strong cycle coming up. So that completes my my presentation. I'm Mark, I'm open to questions if there are any.
There are more than a few. I'll say that very much appreciate the time and the energy. Denis, thank you so much. It's been a busy time in the Q&A column, so clearly you're striking a nerve with the audience. And I will say a fantastic, well-rounded presentation. What a fantastic keynote to start off the day today. Thank you so much for that. Yep. We are going to move right into the question period. And first of all, our colleague Barry is asking, are you seeing any increased aversions to operating in certain political regions, Denis?
Certain aversions?
Yes. Just wondering if there's any concerns out there.
Yeah, well, we've always we've stayed away from safety. Is the security of our employees is top, and we moved away from Burkina Faso. I think about 3 years ago now. It could be 4 years. I don't have the exact date, but I know it was around this time, around November, December, and it was right. It was about 3-4 months before things started to happen there. And the reason we moved out was our security. We have a security firm that helps us. That on a daily basis we get reports, and it was starting. We were starting to see concerns mounting in that area. So we moved out. I don't know. I don't know if things have improved on the ground. We haven't followed it, but that's an example of a place where we moved out, and so we stay away from those areas. But we do have a good handle on, again, with that security firm, a good handle on the risk, and we keep an eye on that on a daily basis. So, and that certainly factors into our decision to move into certain areas.
Wonderful. Thank you, Denis, for that. Next question. What would you say is the biggest challenge in the drilling industry now?
Oh, definitely labor.
Yes.
It's we're, as I mentioned, we in Canada, US, the industry as a whole is at full utilization of qualified drillers, and so therefore the next wave of drills going out will need to basically bring in rookies. In our world, again, as I mentioned, we do have a good training ground. The rookies are not people we're taking off the street and putting at the controls of a rig. They've been helpers for us for a few years. They've been through. They've learned the ropes, and we're putting them on the control. But definitely, we're going. If I use a hockey analogy, we're now going into the third line, and if things keep going, we're going to be on the fourth line. But we do have a good farm system. So
very good. I love that, Denis. Thank you very much for that. Ryan asked a question here, quite interesting. Can you speak a bit, Denis, about utilization rates for major drilling and/or the industry? Where are we now versus the theoretical maximum? And what are some of the challenges associated with reaching that theoretical maximum level?
Yeah, we always said that our maximum, the way we count utilization is if a rig is turning, and if a rig is turning, we count it as utilized. If it's not, we don't. So even if it's locked in for a customer at a certain area, and because of seasons, it's not available, we don't count it as utilized. And because of that, we've always said that 75 to 80% was max utilization we could attain with our fleet. We do have rigs in the Arctic that only work 4 or 5 months of the year, but they do really well in those months, and then we lock them up and come back this next season. So at this point, we're at 52% on that 75 and 80% max.
Okay.
But that is misleading in a sense, because in South America we're more in the 30s, and in North America we're more in the high 60s and moving into that 70 range on rigs. And that basically, that also dictates the pricing environment. And that's us, but that's also industry wide, pretty much. That's what we're seeing in terms of the utilization.
Very good. Denis, thank you for that. Next question here. We see the graph showing the increase in drilling, but when do you think the share price, Denis, particularly junior exploration companies, will match the actual cyclical nature of the drilling industry?
Are you asking our share price or share price of mining companies?
I would say les deux.
Well, our share price, I must say, I was surprised with the kind of results we just produced. We thought that we were going to blow the lid out of our share price and hardly move, but then we released in a week where we were up against everything going on in the world with the variant. So I think we were like on top of a mountain screaming at the top of our lungs and nobody was listening, type of thing. But our time will come, because I really truly believe we're very early in the cycle, so it's just a question of time. What I heard is, or what I'm hearing in talking to a lot of investors, is that there's a lot of people on the sideline just waiting, and we're on a lot of radar. So we'll see. From a junior perspective, I think what we need is a good story, a good discovery that basically everybody. I still remember, and I don't want to bring bad words here on the table, but I still remember Bre-X. I was early in my career, and once I missed out on Bre-X on the upside, everybody was looking for their own Bre-X, and everybody was buying, every junior out there hoping it was. So I'm not saying we need a Bre-X from that perspective, but we need a big discovery that will basically get people pumped and excited about our industry. And there are certainly a few out there, and we just need to get those success stories and those gobbled up by a senior at a big premium, and then people will get excited about who's the next one.
Very good. That's important in the industry, I'm sure. A fairly technical question comes in from our audience member, Eric here, Denis. Is directional drilling or core orientation drilling becoming more popular with early stage projects?
With early stage projects, yes, but it's first of all, you need to find the thing, and once you know which region you want to define, that's where directional drilling comes in. You know which target you really want to hit. So yeah, and it is a type of specialized drilling, because the risk there is, when you move into that, I talked about the risk. You have penalties if you don't hit the target, because the mining companies is not interested into what is above or what's on the sides. It's really targeted to, they want that zone to be defined. So but yeah, it is, we're seeing more and more of that, which is again a different type of specialized drilling.
Again, this is a really excellent perspective for the audience, Denis. Thank you for this. A question comes in: more recently, have operations been affected by the COVID Omicron variant travel restriction?
Not yet. It's too early. It's the nice part, as I mentioned, we don't have a lot of expats, so it tends to be local. And I've talked to the initial hit was South Africa when it came out last week or the week before. And I talked to our South African, and they said, listen, we're not seeing any changes to our operation. Our even through the whole COVID, the biggest limit for us was not the international borders as much as the local borders or the local restrictions. In other words, moving between provinces when for example, in Atlantic Canada, there was a bubble, so we couldn't bring our people from Ontario to drill in Nova Scotia. So those were more the impact, and the same that hit us hard in Chile, Argentina, where the same thing was in place. People couldn't move between states, and then it created real issues, because lots of time our drilling teams live in a different state than where the project is. So, but at this point, this variant is not having any impact on us.
So far, so good. Okay, thank you, Denis. Ryan asks here, Denis, given the sharp jump in demand for drilling services, can you comment a bit about pricing and how does the current pricing environment compare to the peaks of prior cycles?
Yeah, we're still away from where we were at the peak. We're still not back to the pricing that we saw at the peak, but pricing has certainly moved over the last 18 months, 24 months. And as I mentioned, it started in 2020 with the seniors coming to the table and having a lot more activity. And then when juniors came to the table with bigger programs, then really that's where we saw pricing move quite a bit. And but it's by region. Again, North America, we're out of the industry is out of good drillers and good and running out of drills. And I'm sure if you talk to some of the junior mining companies in terms of their ability to source drilling, to source drills for their project, they'll tell you very difficult. And some of them are calling and we're their only option. And that's where, you know, the pricing, lots of time. And I always say, for our managers, and frankly, I tell them, you're already really busy, so the next rig going out it needs to be at a higher price than the one before, because you're going to be putting greener crews. It's going to be more headaches on your shop. It's going to be more headaches on all your system. We're really stressing our systems. Therefore, the pricing needs to be higher, and that's what is creating that environment, because everybody's at the same goal, is in the same boat.
Yes.
And so pricing is going up, and at the same time, the costs, just like any industry and anything, costs are going up, both for labor and material. So therefore, it basically is all translating into pricing. But we've been lucky as an industry that we're able to pass through all these cost inflations in our pricing.
Fascinating. Denis, thank you for that. Time for perhaps one more question here. Ryan asks, given the strong levels of cash flow generation, any thoughts, Denis, about reintroducing a dividend at the company?
We're not there yet. And the reason is that we're still focused on growth. We still see a lot of opportunity to grow going forward, and that's where we're putting our efforts. We made an acquisition back in June and borrowed some money for that. So we're using some of our cash to pay that down. But we are generating, and when you model it going forward, the cash flow is certainly going to add up. But at the same time, we're building up and growing. So growth is still the focus, but down the road, dividend. We paid a dividend from 2008 to 2016, and that could very well be in the cards when you look down the road.
Okay, Denis, I appreciate the openness with that as well. As we do approach the top of the hour, at this point, best that we wind down. It's been a great start to our second day of the VID5 conference. Denis, thank you for bringing your wisdom and insight to the audience. And at the end of this session, folks, we will direct you to a survey. We'd love to hear your thoughts. Denis, thank you for everything you've offered today. I look forward to watching the company moving forward.
Thank you.